go. According to Fannie and Freddie, the conforming limit is 625, and I don't know if that number is accurate today, but that's something that can fluctuate. So you get a little bit here about, not much, but a little bit about jumbo loans. And then your Alt-A loans, these are your, a little bit of a difference between an Alt-A mortgage versus subprime. Again, I wish we had more time. Some of you are going, I'm glad we don't. Get on it, so I will. And we have a little discussion here about hard money, your collateral dependent loans. Those are your hard money loans. And then they mention here the following non-traditional mortgage practices are deserving of increased scrutiny due to higher than average risk to both the lender and the borrower. And so again, this would be a pretty interesting conversation in its own right. But I've asked that they cut about half of that out, and we have no questions from there. Then you have a little bit about the non-qualified mortgage. On page 117, that is any home loan that does not comply with CFPB's existing rules for a qualified mortgage. It doesn't qualify because it's out of those parameters. So a non-QM loan, non-qualifying mortgage loan is not inherently high risk, nor is it subprime. It is simply a loan that does not fit into the complex rules that are associated with these qualifying mortgages. Therefore, many of these loans will actually require extremely high FICO scores, like 825 up to 850, and also what else? Likely other strong borrower attributes like steady job and plentiful assets. So again, the lender's just trying to minimize their risk. And then being able to always think if they default, if that happens, what is the likelihood we'd be able to get our money out of the deal? So, and that's no different than you would think about if you were to lend your best friend money. Yeah? And we certainly aren't their best friends. So here's some of your examples. Interest-only loans are non-qualified products. Stated income and alt-doc loans. I touched on that yesterday, stated income. I did a stated income, no doc loan to purchase a foreclosure property in Phoenix, Arizona, back in 2009 or 10. And so what was I gambling on? Being able to purchase it, put in, do a rehab, and then flip it very quickly, and hope that in the process what happened to the value, it went up. And I did interest only and stated income. They ran with, I told them my income is this, they didn't even verify it. They ran my credit, verified my credit score, and based on that, I could do that very risky loan. By the way, I bought that thing for $160, sold it for around $380, and then I went back in 2013. I go out to Arizona a lot, drove through that subdivision. The house was on the market. In 2012, it was for something like $240. Yeah, so it happened to the people that bought it. They overpaid, and then lost their jobs and whatnot. So bank statement loans, 40-year. Oh, how about that? A 40-year mortgage. Do you realize that when we went into the subprime meltdown, 2008, there were actually 40-year fixed-rate loans out there. Out in where? There's New York, there's London, and then there's California. Everything, rolls uphill. And so they actually had some 40-year fixed-rate loans out in California. You kind of have to out there, don't you? Yeah. But you know what was on the horizon? And probably will be back, 50-year fixed rate. Yeah, a home mortgage for life. How about that? It's kind of like a car payment for life. Anyway, 40-year mortgages, so don't be surprised when you hear a little bit more about those, and maybe even 50 years. Jumbo loans with 10% down, meaning substantially less down than what they like to see. Therefore, those are going to require a much higher credit score. And then recent credit event loans. these are people coming back from bankruptcy and that may have corrected their income and debt situation markedly, and therefore they would consider getting a loan. Maybe they came out of a short sale. When you go in a short sale, it's going to do 50 points to your credit score, just on the mortgage front. What does a foreclosure do? 200 points. Yeah, and it stays there for 10 years. So, all right, anyway, just wanted to do my due diligence there. This stuff here about government loans, we pulled right out of our finance book, so, I can't believe I just hit a button that took me all the way back to, what page are y'all on? 117, thank you. Now I am. And so down at the bottom of the page there, your government loans, FHA, VA, USDA, and I don't think I need to redefine these for us. But one of our questions from this section on FHA is going to be something like, which government agency backs your FHA loans? Who's behind those? HUD is. And what's the official name for HUD? United States Department of Housing and Urban Development. Everyone okay with that? Very top of page 118. In 1965, the FHA became part of the Department of Housing and Urban Development. It was Lyndon Baines Johnson who did that. Who's he? Everybody know who Lyndon Baines Johnson is? Or was? Yeah, he was the Vice President of the United States, and he was from Texas. And he's from down in the Austin area.
I think I'll go here.
Lady Bird Johnson?
What's that?
Is that his wife?
Yeah, Lady Bird Johnson, and Johnson family is still significant, the huge ranch down in South Texas. But anyway, of course, LBJ became the president after, who was shot over in Dallas, November 22nd, 1963. John F. Kennedy, yeah. So that's when they began the war on poverty. We're still fighting the war on poverty, but that's when it officially began. And in that same year is when LBJ, as president, said, I'm not going to now create HUD as a cabinet post position. Okay, it's one of the, anyone in the president's cabinet, that's a very powerful position. Doesn't matter whether it's HUD, transportation, Department of Defense, Department of State, all of those very high-level positions. FHA is the only government agency that operates entirely from its self-generated income and costs the taxpayers nothing. There's very few examples on where you can find that the government actually produces anything, any revenue, and FHA is one of them. Okay. So we need to remember that what government agency backs or oversees FHA loans? HUD. And then as you come down the page, what do we call the name? The name of the lender who's authorized to approve FHA insured loans without prior submission to the FHA or HUD? Yeah, we call them a direct endorsement lender. Can you all remember that today? Direct endorsement lender. Well, just because it's fun. What was number 52 on your test today? C? C, good, okay. Well, it's funny how it plays out this way. So if you don't want to look at this, then don't. Okay, but here's direct endorsement lender, right there. That's where you'll find direct endorsement lender. The rationale here is like 3 inches deep, okay? So I bet you could remember that, but the term FHA, direct lender, is a lender authorized to approve loans for FHA insurance without any prior submission to HUD. The correct term is FHA, direct endorsement lender, or DE, direct endorsement lender.
Or A.
Yeah. Yeah, or A. The purpose of the program is to save time in the mortgage process. We like that, don't we?
Yeah.
We like it as agents, we would like it as consumers too. I'd rather get my loan done faster than slower. For a lender to be eligible for the direct endorsement program, they must comply with fairly strict guidelines set forth by HUD. These guidelines include HUD's review of the company's experience, sound lending practices, financial strength, and overall business conduct. So you've got to be well behaved and have a history of that in the industry, and if so, you could be awarded this status, if you will. As you come down the page, they talk about the two types of MIP on an FHA loan. The first one, they mentioned FHA loans are insured through a combination of UFMIP, upfront mortgage insurance, and the annual mortgage insurance. So that's your MIP. So your UFMIP, they take your loan amount. Most people roll the UFMIP into their loan. It's about 1.75, there it is, 1.75% of the base loan amount. So that's half of what they're putting down on the FHA loan, isn't it? So it makes sense that they would roll the UFMIP into the loan. So now you've got a higher loan balance before you even close the loan. And anyway, it's a simple calculation. It's paid one time. It's paid at closing, typically rolled into the loan. And then it says, then it goes on and talks about your MIP on page 119. You take your base loan amount, and your book says 0.85%, and we know today it just changed this week. It's now 0.55, so it has come down considerably. And I want to make a note here of that. And again, they calculate your initial loan balance, and then at the end of the year, you have paid very little toward principal. You may have paid a hell of a lot toward interest. So on a $250,000 loan at the end of the first year at 5.5%, I just kind of have this one memorized. Then at the end of the year, if you're making payments of around $900 a month, they're $1,100 a month, something like that. Then you've only contributed about $3,000 to retire your principal. The other $12,000, $13,000 has gone toward what? Interest, rent for the use of other people's money. And so nevertheless, at the end of the first year, start of the second year, you have a lower or higher loan balance than you did when you first started. Lower, not by much. And then the next year is going to be lower, isn't it? So at the beginning of each year, or at the end of each year, whatever, because what you end up with and what you start with the next year, that's your loan balance. And so now your MIP, your annual premium, is based on a lower loan, outstanding loan balance. And then you divide that by 12 months, and so is your MIP going to go up? Is it going to be constant, or is it going to go down? Anybody want to brave that answer? It's going to go down. Your MIP is based on your outstanding loan amount. And when is your outstanding loan amount the highest?
Closing.
When you first close the loan. And then you're going to pay on it over time, aren't you? And so at the end of the year, whatever that outstanding loan balance is, it's less than what it was 12 months ago. And so now the calculation's made on a lesser loan balance. And then divided by 12 months, and that becomes your MIP. So your MIP is going down each month. Does that make sense? You still have it on there, but it's getting less and less, not more and more.
Not by much, though.
What's that?
Not by much.
Well, I mean, no, not by much. It's only, again, 0.55. Actually, that's where you might wish it was a little bit higher, because you would be,
Paying more on it.
yeah, you'd bet.
So if you pay
greater
extra payment-
contribution to lowering the amount.
So,
So FHA generates their own income, so that's through these mortgage insurance premiums? Is that
Yeah.
how they make the money?
Yeah, that and,
Then they get the upfront one.
yeah, and then they also, their Fannie and Freddie are also, they are, some of these loans, they actually, they buy and put in their portfolio, and then others of those, they package up and sell them to investors.
So then they lower the mortgage insurance every month, but people don't keep their houses long, so they just turn around and recapture it again and keep going.
Yeah, absolutely. If you do another effort that's going on, that's what they call chunking. Anyway, we don't have any questions from there, but I believe that a quality residential agent is going to be able to explain very generally UFMIP and MIP to a buyer. Let's do one more test question, and we've already run into this before. Go down to the bottom of page 119, where it says interested third-party contributions. The seller and or third party may contribute up to 6% of the lesser of the property's sales price, maybe appraised value, toward the buyer's closing costs, prepaid expenses, discount points, and other financing concessions. So you're gonna have a question from there, and it's gonna come at you pretty early in your test. And the question would be something like, FHA sellers are permitted to provide financing concessions up to 6% of the what?
Purchase price.
Sales price. Yeah, there it is in the book, and that would be your answer, not the loan amount, not the origination charges, but 6% of the sales price. All right, and we know that there are, on every loan program, it just differs depending on the type of loan program. So everybody okay with that? FHA sellers are permitted to provide financing concessions. They can contribute to the buyer's cost of closing up to no more than 6% of what? Sales price. Sales price.
Wow.
All right, and why not do another one? Let me see if we're almost finished here. We're not. This one has the most questions. So let's do one more. And actually, we'll come back. We're gonna look at a reverse mortgage when we come back on page 121. So I want to get real. I want to move quickly. I want to try to get through at least chapter 7 before we break for lunch, and I know we can do that. So I'll see you back here at 10:50. See you right back here at 11 o'clock. Are y'all warm?
Yeah.
Getting warm in here?
Can I find a highlighter from the office?
Yeah, I think they, I'd give you one if I had one, but I think they sell them for about 11. Yeah, I think so too.
I'm always freezing and I'm warm. I said I'm always freezing and I'm warm. I'm not cold.
Oh, yeah, oh, okay.
So it must be.
We just get a little, sometimes it's just a matter of getting the air moving. Let's see if they're blue.
Because when you move, like. Houses come up, guys. You don't have to pay thousands of dollars. Like now, my business is just word of mouth referral. You have to go hunt when you start, like literally. Like you're here, your friends, your family, the people you know.
All my cell phones, you know, was a pro. They were the same thing. Friends so many years ago, potentially I was one of the machines in the house, in South Central, pick up, they explain, she really stopped.
But see, this is the thing, in this business, you just have to continue doing it. Right? If he said, you will have success.
One of them were a little bit off, but we're gonna close. It'll be okay. These are all people from out of state, so it's complicated.
Yes.
Right, how do you do your business work?
Whoa, tax plans, yeah, I buy business, so, yeah,
See, but how long have you been in the business?
3 years.
You need to think of it as something different.
Oh, I'm working, that's one of my broker.
Yeah, but like, You don't need to be one of those.
I get referrals, like now, all my
Exactly.
referrals, but I still like these, things where future business kind of.
True, the new one that you wouldn't have gotten otherwise.
Yeah, yeah,
That's true.
yeah.
That's very true.
Carmen, how'd you get 21 listings and how short of a time frame did you get them? You said that yesterday, right?
Right now.
Like all of this year?
No, this is just this month. I
¿Tienes
have-
un asistente?
Yes, I have.
One or
I
two?
just hired one. Yeah, and I'm about to put another one tomorrow.
How do you balance, I know you had small babies, right? How do you manage that? What's your day look like?
It doesn't look like anything right now, it's so busy.
Right.
It's nuts, it's like literally, it's insane.
Anybody watching?
It could have been 8 years ago, 4 years ago, 8 years ago. I took this.
So are you like kicking yourself like?
Yeah, because
I can feel it.
I took the test and I panicked and then I didn't pass it and then I didn't go back.
You
for 4 years
overthought
later.
yourself.
Like
You're
seriously.
mad at yourself, right? I can feel it from
If somebody gets up and I'm testing, I'm like,
distracted.
stupid.
No, you need to hear it more, but.
Somebody how I passed my test? They had to put me in a separate room.
Oh. You're
So you
easily
get nervous when
distracted.
people leave?
Oh, very.
Easily
Get ready,
distracted.
cause like 5 people leave at the same
Oh,
time.
they do, and I'm like,
Dang.
So are you farming an area or are they just coming as referrals? And I know your husband helps you a lot, right?
no, he does not help me.
Mentirosa.
I swear, you know what?
Mentirosa.
Let me tell you something, every single person always thinks that. in
Assumes.
office. They assume, but when.
But he probably pushes you really hard then.
He doesn't push me, he's focused on his agents. If you really get to know me and my husband, when my assistant now, she's like, oh, she's from you, and I was like, I tell you,
So
like,
it's separate.
because she's actually seen it. Like the other day, she was.
Well, I guess it's healthy that he's not like over your
She
side.
was, the other day, I swear to you, she was at my house, and I had just broken my leg around that time. And so I'm sitting there and I'm like, oh shit, what am I gonna do, what am I gonna do? And so I had Chris go, one of the agents, go show some houses for me. Cause I had the client, and then all of a sudden I go back, I said, I'm gonna take a nap, cause I was hurting. And I go lay down and my phone just starts going ape shit. I get up, no joke. Within an hour and a half after, I had 10 million in the pipeline.
She had 21
And so
listings in
my
like the past
husband-
month.
My husband and Silali, my sister, was sitting at the table and I said, I gotta get back to work, but like, what the fuck, you were gonna sleep? And I was like, I swear to God, like.
Well, what a
it's just-
blessing. I mean, 21 listings in a 30-day period. Shut the front door. Congratulations.
Thank you. It's been a lot of hard work.
So you're part of the point where you can just like say, you know what, I can't. You're people. Can you like turn down people at this point?
No, I don't turn them down, I actually pass them to the agents
Right,
that are in
or that's what
office.
I meant.
And obviously I get a referral fee, but
Yeah.
if they need the business too, I'm gonna pass it on if I can't handle it. But mostly it's listings.
It's amazing. Good job.
It's a lot of hard work and it's insane because you're just like, how the fuck did that just happen?
Can I do an open house at one of your listings? Actually, I'm gonna call you.
You know where I like doing open houses at?
Where?
Like DR Horton.
Really?
Absolutely.
I did it on Sunday.
Oh, I guess that makes sense.
At the organization, and I got a seller and a buyer.
Out of where? Where? Dallas? You're written in Dallas, or is that hers?
The one I do is in Fort Worth.
Oh, Haskell, right? Haskell.
No, this one is Highlands of Chapel Creek.
Oh, Highlands.
Where do you find them? On like Google or what?
No, I have a lot of ties with, I guess, some of the sales reps there. And through them I've met, and so it's kind of been one of those things that applies. Monica, the lady that actually I'm trying to work with now.
So that's considered a referral, right?
What's that?
Wouldn't
Whenever,
that be considered referral?
yeah,
Yeah.
for brokerage, yeah.
Yeah, but they can't receive a commission because the sales agent aren't.
They do not get paid for the deal. Yeah, and that's the nice part about it is like what she said is, if you can help them buy our house, because I know a lot about their build, their process, their homes, and all of that. And so if I can sell them one of their homes, that benefits them. But if not, it benefits me, because then I can take them elsewhere. I wouldn't even.
Right, there you go, smart guy.
Be like, y'all don't like this one, we can go take a look at some other ones right down the road. And then DR Homes offering like $8,000 in concessions and then 5% interest rate or 5.5% or whatever, so, yeah, and when you look at the actual closing disclosures, like, that's around 20.
I'm gonna call Monica at the Highland Chapel to create.
Highlands Chapel,
Oh.
I can give you the name. If
Yeah,
you
go ahead.
want. Her name is Monica.
Uh-huh.
And her phone number is 301-792-6057.
Oh my God.
And your name, so you can tell her where it
Yeah,
is.
Daniel can, she'll know exactly what it is.
Daniel?
I send her a lot of business. But in return, she reciprocates it, you know what I mean? Yeah.
Exactly.
Builders are a really good connection to have when you find the good ones. Like, there's a lot of builders agents that are just there for the 9 to 5, if you ask me. And then there's a lot of them that actually want to become a builder, but obviously it's a better platform for their lifestyle, and so they do what they like.
There you go.
Put your business card and put a little flower or.
I say become a builder, be like a builder. You know, they're selling homes for a builder, basically.
Pots that
I have a cousin that works for a builder, which there's a conflict of interest is there. But it's tricky because, you know, Sammy will ask for stuff and you're not gonna come and put in my license plate. But it's well, not tempting, but it's a challenge for the.
Yeah, Monica doesn't expect any kickbacks, it's just one of those sell a house, you know, and do business. Take care of the clients. He's a new rep. He was like, yeah, you know, they wrote the contract and everything, but I was trying to think, what would I put in this 1 to 4? What would they ask me? What some information on everything? I was like, why don't you fill out a 1 to 4 for your board?
Don't think you that. You take it over.
Yeah, you can tell, like, you can see the little dot.
Oh, loading.
Yeah, and he was thinking about it. I was like,
Cute.
he was like, my bad, dude, it's been one of those days. I'm like, I get it.
So you're trying to get your broker's license as well?
Going to get it. Going to get it.
Name it.
Yeah.
Are you almost done?
No, I just started. Yeah, I don't,
Okay,
I don't, I
let's, get back to it. Hate to break up conversations, but we got about an hour and a half, less than that if we break for lunch a little conversation, but we got about an hour and a half, less than that if we break for lunch a little early. So, we're gonna get as much under our belts as we can. And so, we're gonna get as much under our belts as we can. And if we go to page 121, we're gonna have 2 questions about, they talk about the FHA reverse mortgage. FHA has a reverse mortgage program. There's actually a, you know, it's usually a conventional loan, if you will, but FHA is not the only place you can get a reverse mortgage. So we've been talking about FHA, so you might as well look at it here. So this one obviously through HUD, through the FHA, HUD created one of the first reverse mortgage programs in America, the home equity conversion mortgage. That would have been back in 1960, okay? And so HECM, you're converting your home equity into a new mortgage, so it's appropriately named, home equity conversion mortgage. So that's the, here this is going to be the FHA version of it. But when you go to the second paragraph, it doesn't matter what who's behind it. Reverse mortgages are not like traditional home equity loans that require the borrower to make regular payments until the debt is settled, paid off. So if you take out a home equity loan or a home, you know, like a home equity line of credit, the minute you draw on it, you have to start paying it back, right? Well, a home equity loan, let's not bring in a HELOC, but a home equity loan, you're borrowing a percentage of your equity. You can borrow out no more than 80% in Texas. You always have to have a 20% equity position. So then they give you that lump sum after a 72-hour cooling off period, okay? So if you decided to do a loan like that, after a few too many glasses of wine, then they do not fund those on the day of closing. They have a cooling off period. That was one of the requirements for home equity lending in Texas. And so, but if you take out a home equity loan, you begin to pay it off immediately, don't you? You have to make a mortgage payment. It's like it could be a second mortgage that you're paying back. With a home equity loan, with a reverse mortgage or home equity conversion mortgage, you're not paying it back. The bank is paying you. Okay? So reverse mortgages are not like traditional mortgages or home equity loans that require the borrower to make regular payments until the debt's paid off. A reverse mortgage gives the senior borrower money from the equity in their home in the form of a loan that is not paid back until the borrower, or if more than one, the last of the borrowers dies, sells the property, or for reasons other than death, fails to physically occupy the property, maybe moved into assisted living or something like that, or the borrower fails to perform the obligations under the loan. You have to keep the property in good repair, you have to be current on your property taxes, you have to keep it insured, and you have to do that with any loan, don't you? Yeah, your insurance company could drive by your house today, and if they think you need a paint job, they'll tell you that if you don't get your house painted within 30 or 60 days, then they're gonna remove your insurance coverage, and then what is your lender gonna do with the loan? Call the loan due. Yeah, they're gonna accelerate the loan unless you can find other insurance coverage. So the reverse mortgage gives the elderly borrower a monthly check instead of making a monthly payment. So one of the upsides, I guess, to a home equity loan would be the interest on that mortgage is tax deductible. But so is this the right type of loan for all people? No. In fact, it's not even available to most people. You have to be at least 62 years of age or older. So let's assume that you have 100% equity in your home. That's the only time I would consider doing one of those. But you could have as little as, I say little, you could have 60% equity, you still owe 40%. Those are available at those in those scenarios as well. But let's assume that the senior couple has 100% equity in their home. Whatever the home's worth, 200,000. Let's say it's worth 200,000, and they have 100% equity. How much could they borrow out on a reverse mortgage of 60%, actually 61% of their equity? What if they're 72 or older, 71%? The most that you can get out of your equity of your home without selling it and getting 100% of your equity in Texas is 81% on a reverse annuity mortgage. Okay, 1 point more than what you can get on a a home equity loan. And so so there's advantages to this. The income from it is tax free. So let's say it's a $200,000 home, and you have 100% equity, and you're 72 years old. Then you can borrow 71% of the equity out of your home. So let's say that on the day that you did that, the house was appraised at $200,000. Now 5 years later, it's worth $300,000, $400,000, whatever. It's usually going to go up in value over time. And so the concern a lot of boomers have with their silent generation and GI generation parents in doing reverse annuity mortgages, obviously the boomer doesn't understand it. So I can make a case that if you had, say, a $200,000 home, that you're borrowing 70 or even 80% of your equity out of it in a reverse mortgage, they then crunch those numbers, and you're going to be getting a check each month, the equivalent of it, like a mortgage payment, but it's completely tax-free. Okay. Now, every time you get one of those payments, it's adding up to a loan amount against the house. Okay. But let's say 5 years later, the husband dies, and now the wife is left, mom's left, and she lives for another, say, 12 years. Like my mother lived another 15, 16 years after my father passed away. And so she continues to get these checks tax-free. So now, let's say 20 years later, mom dies. The house was worth 200,000 when they took out the loan 20 years ago. They've actually drawn down 350,000. So they're kind of upside down, aren't they? But an appraiser comes out and says the house is worth 450. What are you going to do? You sell the house for 450, pay off the $360,000 loan balance, and walk away with the difference. And mom and dad were able to stay in their home for the rest of their life. Okay, so and sometimes those numbers can be significantly greater, if you will. But what happens if this happened to be mom and dad's home, and they it was 200,000 when they took out the loan? 20 years later, this thing's worth 200,000 still. And but yet they've drawn out $350,000, $380,000, $400,000 over time. What do you do with it then if you're the one that's going to inherit it? Just let the bank have it. It's no reflection on your credit, none. So just the bank takes it back. That's the roll of the dice that they take when they do that type of a loan. So and you get here your borrower requirements on page 122. You got to be minimum 62 years of age or older. Own the property outright or have paid down a considerable amount, like where you have 60% equity, I think is the minimum. Occupy the property as your principal residence, not be delinquent on any federal debt, and have financial resources, sufficient reserves, if you will, to make sure you're going to be able to pay your property taxes, your insurance, HOA if there is one, etc. So I'm married. I've been married a few times. So had a friend of mine tell me the other day, God, I can't believe I've been married 28 years. And I go, I haven't even been married that long in 4 marriages. So good for him. Anyway, the reason I mentioned that is, why did I mention that? Sorry, it had to do with something that was right here. But anyway, it'll come back. Oh, by the way, it came back to me. The other name for a mortgage-backed security is a CDO, a collateralized debt obligation. Okay. This guy pulled it out of me. So something that slipped my mind a little while ago, a CDO, collateralized debt obligation. So anyway, what was I going to say? Damn it.
You talk about marriage 4 times, 10 times. You
What's
talk
that?
about your friend, you was talking about marriage.
Oh yeah, I know, but it had some. Oh, I know what it was. Yeah, that my wife's never been married. She never had any children. I've got 2 children. I've got a daughter in Australia who's an attorney there, and she's done quite well. I've got a son who doesn't know how to spell work, and so he'll see nothing until he figures out what that word's all about. And so our plan right now is when we turn 70, when I turn 72, I'm older than my wife, just one of the members of the family has to do it. And then we're gonna suck out every bit of the equity in our home. Every bit of it. And we're gonna, so for some people, can you see where the reverse annuity mortgage could be the difference between being able to stay in the home and maybe pay for medications? And then for some people, it could be that pay could be the difference between a good retirement and an excellent retirement. And that's where it is, what it's going to be for my wife and I. So then again, even if I had a child or children that we wanted to leave the property to, we would still do the home equity conversion mortgage or RAM, reverse annuity mortgage. And then we would hope that when we pass on, that whatever we drew down against the property and versus the appreciation is significantly different. So there would be something left over for the children if you're worried about an inheritance, if you will. And it talks about some of the different ways you can pay it back. They have 5 repayment plans. By the way, before you can even consider a RAM, you'd be considered for the RAM, you've got to go through counseling. You know, they want to make sure you know what you're getting into. These are a little bit more expensive loans. You could do most people would do a modified term where they combine a line of credit plus monthly payments for a fixed period. What you probably wouldn't want to do is just pull it all out in one big chunk at that time. That's pretty dangerous. So they do have these different plans that accommodate most scenarios. There's a little bit about counseling. It does have mortgage insurance on it that's paid at closing. It's a 2% upfront fee. And then your annual MIP is a half a point, so it's less than what you get on FHA today. And actually, that number may have come down a little bit as well. So there's quite a bit there, but not near as much as you could have. But we have two questions about RAMs, reverse annuity mortgages. Understand what you're doing. What do you do over time with a whole life insurance policy? You pay monthly premiums, don't you? And you build up a cash value until you reach the term of the like 30-year whole life policy, not term, whole life. Then what do? You flip it over and you can deplete it over time. That's an annuity, okay? So typically annuities are insurance investments over time. Once they're fully funded, then you annuitize it over 10 years, 20 years, 30 years, and you get money that you're drawing down. You've annuitized your insurance policy. Well, this is a reverse annuity mortgage. It's just called a reverse mortgage now, but what you're doing is annuitizing the equity in your home. So you reach to where you have 100% equity, and now it's going to start paying you back over a particular term. So, so what I would do, if some people might want to take a chunk of that and pay off debt, interest, things like credit cards and whatnot, and then take the rest over time. I would never do one of these unless I was going to take it over for a lifetime income. So you're going to get a little bit less each month, but you're going to get it guaranteed for life. So, so let's see if we can knock back our questions here. The type of mortgage that's going to provide an elderly, I hate that word, elderly borrower with a monthly check instead of the borrower paying a monthly payment is known as a what?
Reverse mortgage.
That's a reverse mortgage, okay? And then another question from there. A borrower is 65 years old, a retiree with significant equity in his or her home or their home. Which of the following would be the best option to assist them with paying for repairs on this home? Would it be a home equity line of credit, an adjustable rate mortgage, an SISA, not sure what that is, or an HECM?
HECM.
And what's an HECM? It's just the original name for a reverse mortgage.
SISA is stated income stated asset, Tom.
What's that?
Stated income stated asset.
Oh, that's right, yeah, that is SISA,
Back
sorry.
in the late days.
Yeah, I knew that, but no, that would not be the route that they would go. So, so the home equity conversion mortgage, it was actually created by, the concept of it was born from a football coach's wife in 1960, where the football coach had, made a decent living over the years. But he passed away, and there was significant mortgage in the home, and the wife didn't want to move out of the home. She wanted to remain in the home. So she sat down with their banker and looked at different ways that they could keep her in the home, contribute to her income. Remember, it's tax-free, and you don't have to even credit qualify for it, okay? That may change, the credit qualifying, but the tax-free point won't. Wait till you're over 60 years old and see what the words tax-free mean to you. It's pretty big. And so, so thus the HECM mortgage was born in 1960. But it took a hell of a long time for it to show up here in Texas. We've always had a different view on equity lending. And just in case you know, people will ask you, they'll move here from other states, won't they? Prior to 1997 in Texas, if somebody moved here from California and they said, wow, we just sold a big house in California, we can buy twice the house here for a quarter the money. Yeah, you can. But what if you need some of that cash out for your kids' college or whatever? We'll just do a home equity loan. Not here, you won't. You couldn't do them in Texas until 1997. What happened? Well, over about 2 decades, 2 schools of thought conflicted on whether or not home equity lending should be allowed in our state. One of the camps said you should never be able to borrow your equity out of your home that you paid for. That's pretty extreme. The other camp said you should be able to get any and all of your equity out of your home because it is your home and you're the one that has paid for it. So those were 2 polar opposite camps, right? Well, finally, in 1997, they came together, and I don't know who promoted it, but they said, well, how about we compromise? What a novel idea. And so let's put a limit on it to where you can borrow equity out of your home, but it can be no more than 80%. Well, that seems reasonable. And so, so thus the home equity loan was born in Texas, 1997, which happened to also be the year that our federal capital gains tax laws changed to where you could, if you're a single person, a gain of 250,000 or less is completely tax-free, $500,000 on a married couple. Do y'all remember that? That too, you talk to homeowners about all the time, okay? And you really need to be aware of that. And most of them already are. So, so you gotta be somewhat familiar with some of these tax laws. And what a hero you would be if you were, say, working with one of your niche markets with seniors, as was mine. And now I am one. But where you could propose this to the children. When you're working with seniors, you're usually involving the children in some form or fashion. And by the way, if you can serve the elderly community, the older community, senior community, they are the most likely to give you referrals. They're the most loyal people on the planet. And if you serve them well, they will ring your cymbal till the day they plant them. And they will tell their children. And if you build up trust with them and their parents trust you, they'll trust you as well. So you're actually opening the door to 2 or 3 different generations that you can serve. And by the way, who has all the money? Which generation has all the money today? Baby boomers. We control over 50% of corporate stock. We control 70% of money market accounts. Our wages are 4 times the average, and I could go on. We have all the dough. So if you're going to focus on the high end of the market, which generation are you is going to be your bullseye? Baby boomers, absolutely. We also hold the jobs that the younger generations want, but ain't getting yet, are they? Because we're actually living longer. So we'll die off. Be patient, and that money will go to someone. So we've got 2 questions about the reverse annuity mortgage. One of them, the answer is reverse annuity mortgage, and that was simply the type of mortgage that provides an elderly borrower, that will be your clue, with a monthly check instead of them paying a monthly mortgage payment. And by the way, if you had, say, 70% equity, you could do your RAM and use a one-time chunk to pay off your existing mortgage. And you can also use it to build a new home. So then you sell this one, and you got the money went to build the new home that you're now going to occupy, and so it can play out. It can really meet almost every scenario that one might have. And anyway, so that's one of your questions, and then the other one was a scenario question concerning the well, oh, there it is. Borrower is 65 years old, retired, lots of equity in their home. Which the following would be their best option to assist them in paying for the repairs in the home? HECM. HECM, just another name for a reverse mortgage. So it goes on, talks about counseling and whatnot. You get to page 123, and then we've got a little bit here about the U.S. Department of Veterans Affairs, the VA loan program. We know the VA doesn't lend money. They have a guarantee program. The VA does not loan money. Look at that box. But it does back loans made by private lenders to qualified veterans. Your test question, I bet you know these test questions already, and in fact, we're only going to see 2 about the VA loan. So I bet you already know these. Let's see, and if not, we'll certainly go a little deeper if we need to. How about The U.S. Department of Veterans Affairs does not make loans. What does it do? Does it provide down payment assistance to veterans? Does it, is it a co-signed loan for qualified veterans? Does it insure loans made by lenders to qualified veterans?
Yes.
No, that's, I guess you'd say that'd be an FHA loan to a veteran, if you will. They guarantee loans made by lenders to qualified veterans. Okay, the VA guarantees loans. The VA guarantees loans. They don't lend money. And then, your other question, from here would be, I think it has to do with, they have to have their ducks in a row, if you will. They need to be able to produce their DD 214, Department of Defense Form 214, that says they've been honorably discharged unless they're active duty. And then what's the other thing we need? And down the bottom, I asked you to highlight it. I don't know if you did, but
Where is it?
their certificate of eligibility, their COE. So a lender may rely on what document is proof that the veteran has available entitlement for a home loan benefit. It is the certificate of eligibility. I teach a course called MRP, Military Relocation Professional. Taught it for many years, and in that one-day course, we actually we don't even go through how to calculate their entitlements, but we make you aware of how that's done. Because that's the last thing you'd want to do is sit down with a veteran or an active duty party and then try to figure out what their entitlements would be. The VA lender is the best. The party that specializes in VA lending would be the best person to do that. By the way, don't ever just refer a veteran to any lender. You definitely want them to go to somebody that specializes in VA loans. In fact, that's the only loans they do. And companies like WJ Starkey and others that have actual VA divisions. Okay, that's in the best interest of the veteran. And many of your VA loan originators are actually what? Veterans. Yeah, so what better person, that's the whole purpose of the MRP class, is so you can begin to understand the veteran and active duty mentality, if you will. It's a different market, and also teaches you a lot of their vocabulary and whatnot. What do you call a move in the military? It's called PCSing. It's a permanent change of station. So you thought we spoke in acronyms. The military really speaks in acronyms. There's all sorts of acronyms you learn in that course. So what is it what document will the VA rely on as proof that the veteran has available entitlement? Your COE, right there on page 123. Certificate of eligibility is a document issued by the Veterans Administration. And by the way, that needs to be corrected because that is not the proper name. To qualified veterans, entitling them to VA guaranteed loans. The certificate can be obtained through the local VA offices by submitting Form DD 214. Those are your separation papers. You don't need to know that, but a VA Form 1880 requesting your certificate of eligibility. Kansas City, there's a big building somewhere that has records on all veterans from all time. And I've been told that if you do lose your certificate of eligibility or any of these forms, that they can actually produce it pretty quickly. So we've got a lot of stuff there. You could learn more about the VA loan. Those are two of your questions. And then on page 125, it's not one of your questions today. But as you come down the page with regard to what? Interested third-party contributions, AKA seller contributions, there is a limit of 4%, 4% of the sales price. Everybody see that? There's a funding fee that can oftentimes be waived. The funding fee, I believe, is something that can be paid by the lender. It can be paid by the other party. You know, so sometimes they may even waive it. I think they do that for disabled veterans and whatnot. And by the way, a 100% disabled veteran in Texas what percentage of their actual unexempt tax bill do they pay?
0.
Zero, not a nothing, okay? That's the least we can do for, veterans, a disabled veteran. So, they have no tax bill, I'm willing to pick up my share. By the way, how many veterans do we have in Texas? About 1.2 million. Yeah, pretty good number. Do you have a question?
No, she was saying she was a vet.
Oh, are you a vet? Okay, did I ask that yesterday? I usually do when I'm getting ready to start, to talk about, VA loans, but, do you have a VA loan?
Yes, I do.
And you have been, the VA loan for a few years, or?
Yes.
Yeah, anything you care to share about it? It's a good loan program, isn't it?
It is, you don't have to come out closing, like, very minimal. And once you get the 100% exemption, it brings your mortgage down a whole lot.
And, I think, I'm not sure if we talked about this, or maybe it was in prep over the weekend, I taught prep, so we would have talked about some of these, programs. But, I'm not a veteran, could I assume her VA, loan?
Yes.
I can, if I credit qualify. But why would you not want my VA loan assumed? Your entitlements are locked up in that
And
loan.
if you default, it goes back on her.
Not without a release of, you get a release of liability signed. So, you do that on any qualifying assumption. But yeah, no veteran would want a non-veteran to assume the loan. And that gets rid of a myth. A lot of people think that those benefits are one time. No, you can use them multiple times. And actually, there's no limit on a VA loan any longer. So you can actually, apply your entitlements to $1 million purchase, you know, if you qualify.
And with VA loans, the requirements typically are more specific to the lender because they're really more relaxed. Like VA loan requirements are a lot more open, you know what I mean, versus FHA or conventional. So really the lender kind of sets that conforming loan requirement.
Correct. So, yeah, they're much more liberal on the, the ratio is at 41%. So they look at it completely differently. And, but anyway, just some of the things. Can you leave your VA entitlements to your children?
Yeah.
No?
Right.
No, only to your, only to a surviving spouse. And, it used to be for a 5-year period, and, now it's, for the balance of his or her life, provided they don't remarry, okay? And so, anyway, just some of the stuff we talked about in the MRP class. Yeah.
Is the HECM, can you do that? Like if my parents were to do the reverse and then fix their house up, sell it, could they do another one on their next home if they had equity?
Yeah, they would pay off the, whatever loan balance they had accumulated on it through the RAM, and then they could do it again, absolutely. Probably if that's all they're gonna do is get money out of it to rehab it and then flip it, that would be, you'd probably wanna go with a home equity loan or even a home improvement loan, something like that. That's gonna be paid off at closing. So have them explore that. Then, so we have 3 questions about the, no, actually 2 questions about the VA loan. And then you have your rural housing service programs, better known as your rural housing, your USDA loan, United States Department of Agriculture. So the Rural Housing Service, RHS, is an agency of the U.S. Department of Agriculture. Goes back to established 1994. The RHS was created by the Department of Agriculture, Reorganization Act, whatever. The mission of the RHS service program to improve the quality of life in rural areas. So oftentimes this is called a Section 502 loan, which would be your more official title for it. And so I don't think we have any questions about USDA loans, but if you, and sure as I said that we do, go to page 127, and you're only going to need to remember that USDA loans are available in what? And I asked you to highlight in a rural area where the population is not in excess of 10,000 people. Okay, I believe that's the answer. And the question, I believe, is something like that. So, and I had mentioned that, if you think you're gonna do a USDA loan in a particular area, well, you probably ought to get on it because this is a moving target, if you will. Those population numbers can change. So, and also, sometimes people refer to the USDA loan as kind of a hybrid of the VA loan and the FHA loan. Why? It's a zero down loan, so that's very attractive to any buyer or borrower. So that's more like the VA loan, and then there's an insurance component as well, so it's a little bit like the FHA loan, okay? So a little bit of the highlights: 100% financing, no down payment, no maximum purchase price, closing costs can be included in the loan. Again, you're not going to be tested on any of this, and then a little bit there about applicants' eligibility and so on. Then, as we approach the end of this chapter, some other mortgage loan products. 30-year or 15-year fixed rate mortgage, any type of, unless it's an adjustable rate mortgage or it is a partially amortizing loan, even that's a fixed rate mortgage for a short period of time. So we know for most people on a budget, needing to keep an eye on that, they want to know what that house payment is, they don't want it adjusting or whatever, then the fixed rate home loan, the fixed rate mortgage has typically been the way to go. It was created by HUD a long time ago as we came out of the Great Depression. Prior to the Great Depression, people didn't pay off their home over time. They did an interest only, a term loan is what they called it, or straight loan. And they would do typically 5 years, and they're just paying the interest on it, and they would refinance it. And then of course they get to some point where they sell it, and hopefully it's worth more than what they owe on it, right? So they sell it for that, and then pay off the principal balance. And but the Great Depression took care of that. Most people were not in a position to even make a house payment. So adjustable rate mortgages, we know these can be very complex. In fact, if you, as I just looked for some questions here, and I don't think we're going to have any, if you were to, I believe it's in here, go with me to a section that, it's not in here, but in our finance book, it talks about one of the downsides sides of an adjustable rate mortgage is they're confusing. They're very difficult for the consumer to understand, and they can be very difficult for the lender to explain to someone. So anyway, we don't have a test question. Where would you probably find an escalation clause in a loan program? In a mortgage, it would be an adjustable rate. We know that the best time to do an adjustable rate mortgage is when interest rates are going down, not when they're going up. So I doubt very few people are getting into ARMs right now, even though rates do fluctuate, do maybe go down, but if the trend is down. Also, we used to ask you a scenario type question. A older couple, been in their home or getting into a home, and they're going to be there for the balance of their life. Which type of loan program would probably be best suited for them? They're on a fixed income and whatever would be the fixed rate mortgage, right? Wouldn't be an adjustable rate. That'd be more for the most people who take out an ARM. They're probably going to sell the house before they actually before the program even adjusts. So it's a little bit of a roll of the dice. They actually have interest-only ARMs, and so they can be a little confusing. Well, so let's put that one behind us. And what about a balloon mortgage? Well, here a balloon mortgage is the mortgage is it's a partially amortized loan, or it's not fully amortized. A fully amortized loan says that at the end of the term you have no debt. You have paid off that loan balance over time. It's been fully amortized. A partially amortized loan says that at the end of the term, 5 years, 10 years, you still have an outstanding loan balance that's ballooned. I don't think you could get one of these today. for a home loan today. I just don't think you'd find anyone that's offering them. But you can sure get a balloon loan on a car, can't you? And this is the kind of loan that, the party that really shouldn't be buying that Lexus or Beamer, but they can get into it with a balloon loan on an automobile. They shouldn't be driving a Lexus, they ought to be driving a Geo or a Cobalt, whatever. But it allows them to get into the car at a reasonable payment for a term, say maybe 4 or 5 years, and then what happens when the last payment is due? It balloons. So now you owe $30,000, your last payment is that, and so what are you gonna have to do? Refinance the car. Okay, so you end up with a car payment for a better part of your life. So, those are foolish loans to get into if you are fiscally responsible at all. And people don't really care what kind of car you drive. Again, this is America, I say it all the time, we spend money we don't have to buy things we don't need to impress people we hate. It's the American way. What's that? It is. And you don't have to buy into it. And that'll put you in a different club from
But
most
it's
of
common
the.
in commercial, right?
What's that?
It's common in commercial.
Yeah, you can find pretty much any type of program you could conceive and create in commercial. It's not regulated at all. So a very good friend of mine, I think he's approaching 90 years old. His name's Bob Faust, and he's probably your best known commercial lender over in the Dallas area. So we have a question about a balloon mortgage, and you're going to be asked to describe it. So tell me when I have described the best description of a balloon mortgage. Is it a budget type loan? Just kind of think on that one. The beginning monthly payment is large and the final payment is small. No, it's actually the other way. It's a negatively amortized loan. No, it's a partially amortized loan. So a fully amortized loan says at the end of the term your loan is paid off. Partially amortized says partially paid off, but you still have a big balloon payment balance due. It's a partially amortized loan with a final payment substantially larger than the others. Anybody can remember that? Okay. No? Can't remember that? I bet you can. A balloon mortgage is a partially amortized loan where the final payment is going to be significantly, substantially larger than your other payments. Okay? So you're driving around that Lexus for 5 years because you can wear the $600 payments. But now at the end of the 5th year, you still have a $38,000 loan balance. What are you going to do? Sell the car and think you're going to pay off the loan amount? No, because cars are typically not what? Good investments.
Depreciate.
No bueno.
What's that?
No bueno.
Depreciate. Cars depreciate.
Yeah, they're not good investments. They're kind of like airline stocks. They're not good investments. So anyway, that's typically where you can find one of these today. There's some of your facts about balloon mortgages. And then a little bit about construction loans. And for those of you that are working with buyers that are doing rehab projects and whatnot, I think you might find this little section interesting. We don't have any questions from there. We do have a question though, and I think it's approaching our last question. Approaching, but not the last question. The bi-weekly mortgage loan. What is a bi-weekly mortgage? It's simply a loan program where the borrower makes payments of principal and interest every 2 weeks rather than once a month. Everybody okay with that? And so what is happening when you do that? You're actually eliminating your principal a little bit faster. You've heard these tales of somebody that if they religiously made 13 payments a year rather than 12, they have a 30-year loan, they make a 13th payment in December, and they send a separate check, and in the memo section says, here's my here's another payment for this month, apply to principal. Then you're surrendering a little more principal, you can turn that 30-year loan into about a 23-year loan. What if you were able to make 2 payments each year, then you can turn that 30-year loan into probably a 17, 18-year loan. And 20 years, 30 years can go by pretty quickly, but the faster the better when it comes to paying down that loan. The problem is, are you disciplined to do that? And most people aren't. So a loan where where loan payments are made every 2 weeks, rather than just once a month, that is considered a bi-weekly mortgage, and it's just one of a few ways that you can begin to eliminate principal more quickly, okay? And they give you a good example of that. Fast forward to home equity loans. I've given you a little bit of information on the history of home equity lending in Texas, page 134. There's not much of that there. But I want you to come down to the very bottom of page 134. And I said this paragraph about a non-recourse loan. Non-recourse debt or a non-recourse loan is a secured loan secured by a pledge of collateral, typically real property, but for which the borrower is not personally liable. If the borrower defaults, the lender can seize and sell the collateral, the house, if you will, but the collateral sells for less than the debt. The lender cannot seek that deficiency balance from the borrower. The debt's recovery is limited only to the value of the collateral. So let's put that in plain English. You have a home loan on your home, you're foreclosed on, you owe $200,000 and they were only able to sell the house for $180,000. In some states, they can come after you for that deficiency, that $20,000 shortfall, and they file what's called a deficiency. They get a deficiency judgment. They 1098 you. That's called phantom income. So now you not only lost your home, but you have a $20,000 issue with our dear friends at the IRS.
What if you short sold the home?
Well, that's where I'm going with that.
Okay.
Is that in Texas, on a first lien mortgage, it's a non-recourse loan. They cannot come after you for that deficiency in Texas. We're a non-recourse state. And there are some other states that are as well. California, they will come after you for the deficiency on the first lien. What if you had a second lien, like a home equity loan or home equity line of credit in Texas? They'll come after you for the deficiency on the second lien, but not on the first lien. Okay, you're not going to be tested on that, but it's worth noting. Now, so that's why people often do short sales, where you're getting permission from the lender to sell the property for less than what's owed. So, and that's an excellent alternative to foreclosure. You're still losing your home, but it's an excellent alternative. I've done over 300 short sales and foreclosures. 2/3 of them were 2008 through 2013. During those subprime meltdown years, there were plenty of foreclosures and short sales out there. So what's the name of a mortgage loan that's secured by a pledge of the property, but for which the borrower is not personally liable? That sounds like they're not liable for the entire loan amount. That is called a non-recourse loan. Everybody okay with that?
That's a test question, correct?
Yeah, that's a test question. Do you know what a non-recourse loan is? So it's one where they're not going to be able to come after you for the deficiency. What's the name of a mortgage loan that is secured by a pledge of real property, but for which the borrower is not personally liable? They're not liable for the deficiency, the shortfall. So let's make it real easy. Fair enough? Okay. So no one's accused me of not helping you where I can. Okay, I'm not going to do it for you, but. And then you've got a little bit here about some other insurances. Your PMI, that's your mortgage insurance on a high loan-to-value conventional loan. We also have to have a little understanding about hazard insurance.